There is a number sitting in a government file right now, and it has your name attached to it, not a metaphor. An actual dollar figure, already calculated, already owed, already yours. Some of it is sitting with the IRS. Some of it is sitting with your county. Some of it is sitting with the state agency that handles your pension taxes. And some of it is sitting with Medicare, quietly overcharging you every single month for a job you don't even have anymore. Nobody's going to mail you a check for it. Nobody's going to call and say, hey, you're owed money. The system was never built to chase you down and hand you a refund. It was built so that you have to ask for it. By name, on the right form, at the right office. And if you never ask, the money just stays exactly where it is, forever. So today, I want to walk you through 5 real refunds that people over 65 are entitled to, and almost never collect. I'll give you the dollar amounts, the exact forms, and the exact place to send them. And I'll do it through one retiree's actual numbers so you can see how this plays out in a real budget, not just in the abstract. By the end, her total comes out to just over $4,800. And here's the part that should really get your attention. Most people watching this qualify for at least 3 of the 5 refunds I'm about to cover. Before we get into the details, one honest disclaimer, because I take this seriously. I'm not a CPA, I'm not an attorney, and I'm not a licensed financial advisor. What follows is general educational information based on current tax rules. And every single program I mention has its own eligibility rules that shift depending on your state, your county, and your specific numbers. Treat this as a map, not a GPS. Before you file anything, run it past your own tax preparer or your local revenue office. Okay, let's meet Margaret. Margaret is 68. She spent 30 years teaching 4th grade in a mid-sized Ohio school district before retiring 3 years ago. She's lived in the same brick colonial since 1998. The mortgage has been gone for almost a decade, and the only major expense left on the house was a new furnace 2 winters ago. Margaret brings in $21,000 a year from Social Security, $18,000 from her teacher's pension, and she pulls another $11,000 out of her IRA to round things out. $50,000 a year, give or take. Not extravagant, but comfortable. She reuses tea bags twice, keeps a running grocery list taped to the fridge, and has never once bounced a check in her life. She's used the same tax preparer at a strip mall franchise since she moved into the house. She trusts him completely. She's never been audited, never gotten a threatening letter, never had a reason to think twice about her paperwork. As far as she knows, everything is exactly as it should be. It isn't. Right now, across 4 different government offices, there's $4,832 sitting with Margaret's name on it, and she has absolutely no idea it exists, because nobody has ever told her to go get it. Let's start with the newest one on the list, because it's the one almost nobody has heard of yet. Recent tax legislation created a brand new deduction specifically for filers 65 and older, $6,000 if you're single, $12,000 if you're a married couple, and both spouses qualify. This stacks on top of your regular standard deduction and on top of the extra deduction seniors already got before this law existed. It only phases out once your modified adjusted gross income crosses $75,000 for single filers or $150,000 for a married couple. Under those thresholds, you get the whole thing. Margaret's adjusted gross income sits around $43,000, nowhere close to the limit. She should have had that $6,000 deduction applied automatically on her last return. She didn't get it. Why? Because this deduction is brand new, and a lot of the tax software used at big preparation chains simply hadn't caught up to it by filing season. Nobody flagged it. Nobody mentioned it. It just quietly didn't happen, and Margaret ended up paying about $700 more in federal tax than the law actually required. The fix is one form, a 1040X amended return, with the missing deduction added back in. The IRS typically processes these within a couple of months. If you're over 65 and under those income limits, stop this video right now, pull up your last return, and look for that deduction. If it's not there, that's real money sitting with your name on it, and you have up to 3 years to go back and claim it. Now let's talk about the money hiding in your property tax bill, because this one applies almost everywhere in the country, just under different names depending on where you live. Homestead exemptions, senior freezes, circuit breakers, tax deferral programs, different labels, same basic idea. The government builds in relief for older homeowners, and then makes you apply for it yourself instead of applying it automatically. Margaret's house is assessed around $260,000, and her local rate works out to roughly $4,600 a year in property taxes. On a house she owns outright. Ohio runs a homestead exemption program for seniors that knocks a set amount off your home's taxable value, which for someone at Margaret's income translates to real annual savings, plus a supplemental circuit breaker credit in some counties for lower and middle income seniors. Margaret has lived in that house for years and never filed the paperwork. Nobody at the county mentioned it. Nobody at her tax preparer's office mentioned it. She simply paid the full bill every single year because that's what the bill said to pay. Once you widen the lens past Ohio, the numbers get even bigger. In Texas, stacking the senior Homestead exemption with a school district tax, frees can save $3,000 to $5,000 a year. In Florida, seniors who've stayed in their homes a long time can lean on assessment caps that keep taxes from spiking even as home values climb. In Georgia, some counties let seniors over 62 skip school district property taxes entirely, and that's often the single largest chunk of the whole bill. In New York, an enhanced exemption for seniors under a certain income threshold can shave over $1,000 a year off in some counties. In Illinois, a senior assessment frees locks in your home's taxable value, so it doesn't matter what your neighbor's house just sold for. The pattern repeats in nearly every state. The relief exists, and almost nobody applies for it because nobody ever tells them it's sitting there. Here's the move. Call your county assessor's office directly, not the tax collector's office, and ask one simple question. I'm over 65 and I own my home outright. What's senior? Exemptions am I eligible for? And can I apply retroactively? That single call takes about 10 minutes and could be worth thousands. Refund number 3 is the one that tends to make people the angriest, because it usually means they've been overpaying for years without knowing it. A surprising number of states don't tax retirement income at all. Pensions, IRA withdrawals, 401k, distributions, Social Security, all of it completely exempt at the state level. Pennsylvania does this, so do Illinois and Mississippi. Iowa phased in a full exemption for residents 55 and up. New York excludes a chunk of pension and retirement account income per person. New Jersey lets married couples over 62 exclude up to $100,000 combined. Ohio is a little different. It doesn't fully exempt retirement income the way Pennsylvania does, but it offers a retirement income credit that most filers, using generic, multi-state tax software, never get correctly applied, especially older retirees whose preparers handle returns from a dozen different states and don't dig into every state. Specific credit line. In Margaret's case, that missed credit cost her roughly $300 a year for the last 2 years. $600 sitting with the state that never should have been collected. If you live in Pennsylvania, Illinois, Mississippi, Iowa, New York, or New Jersey, this is the single most important thing you do after watching this video. Pull out last year's state return and find the line where your retirement income exclusion or credit should appear. If it's blank or shows 0, you've been overpaying, possibly for years, and you can typically go back 2 to 3 years and amend it. For someone in Pennsylvania sitting on $30,000 of exempt retirement income, 3 years of amended returns can mean close to $3,000 back. In a higher tax state like Illinois, that number climbs even higher. Now for refund number 4, and this one has nothing to do with hiding money. It's about a penalty that never should have existed in the first place. When you're working, your paycheck automatically withholds roughly the right amount of tax because your employer's payroll system handles it for you. The day you retire, that system disappears, and suddenly you've got 2 or 3 separate income streams, Social Security, a pension, an IRA, each with its own separate, uncoordinated withholding rules, and none of them talking to each other. Social Security won't withhold a single dollar unless you specifically request it. Your pension withholds based on a form you filled out on your very last day of work, and often without fully understanding what your tax picture would look like as a retiree. And your IRA custodian defaults to a flat withholding percentage, usually 10 or 20%, completely disconnected from your actual bracket. Put those 3 gaps together, and most brand new retirees end up underwithheld in their first year or 2, then get hit with an underpayment penalty on top of the tax bill they already owed. That's exactly what happened to Margaret. Her first year off the payroll, her combined withholding fell about $3,800 short of what she actually owed. And the IRS tacked on a roughly $200 penalty for underpayment. Here's what almost nobody tells new retirees. The IRS has a built-in waiver for exactly this situation. If you're 62 or older and you retired in the current or immediately preceding tax year, and you had a reasonable cause for the shortfall, you can request that the penalty be waived entirely using IRS Form 2210 with a retirement-specific box checked. One form, one checkbox, penalty gone. Margaret's preparer never filed it, so she paid the $200 and never knew the waiver existed. She can still amend her return within 3 years and get it back. And going forward, there's a permanent fix. The safe harbor rule says that if your total withholding across all your income sources matches at least 100% of what you owed last year, you're protected from underpayment penalties no matter what happens this year. The easiest way to hit that number is to file a W-4V with Social Security requesting a specific withholding percentage, and to call your IRA custodian and adjust your withholding from the generic default to something that actually matches your real bracket. Which brings us to the 5th and final refund. And if you didn't recently retire from a higher paying job, this one might not apply to you. But if it does, it's often the biggest number on the list. Medicare charges an income-based surcharge on top of your regular Part B and Part D premiums once your income crosses a certain threshold. And the tricky part is that Medicare bases this year's premium on your tax return from 2 years ago. So this year's bill is calculated off of income you earned back when you were still working full-time. Margaret retired from teaching, but let's say a higher earning retiree, someone who left a job paying well over the threshold 2 years before their Medicare premiums were set. A retiree would get hit with that surcharge automatically, even though their current income has dropped dramatically. Depending on the bracket, that surcharge can run well over $1,000 a year in extra premiums, layered onto standard Part B and Part D costs, for income that no longer exists. The fix is a form called SSA 44, and it exists specifically so you can tell Social Security, use my current income, not my 2-year-old tax return, because I've had a life-changing event. Retirement counts. Reduced work hours count. A one-time windfall, like selling a house or a big single IRA withdrawal, does not count. That's an important distinction because the form is built for permanent income changes, not one-off spikes. You file the SSA 44 with documentation, a letter from your former employer, a final pay stub, or a pension start letter, either by mail, by phone, or in person at your local Social Security office. If approved, your premium resets to the standard rate, and any months you overpaid in the meantime often come back to you as a credit. The important nuance here is that this surcharge would eventually correct itself on its own once Medicare processes your lower post-retirement income 2 years down the road. But that's 1 to 2 years of unnecessary overpayment you don't have to sit through if you just file the form now. So let's add it up using Margaret's real numbers. The missed senior deduction, $700. The unclaimed property tax relief, retroactive for 2 years, somewhere around $800. The missed state retirement income credit for 2 years, $600. The wrongly charged underpayment penalty, $200, enrolling in a Medicare IRMA correction scenario at roughly the national average adjustment. You land right around $4,800, recovered from 5 separate government offices, none of which were ever going to volunteer it. But here's what really changes the math. This isn't just a one-time windfall. Once these corrections are in place, they keep paying out every single year going forward. The senior deduction alone is worth $700 annually, permanently, as long as she stays under the income threshold. The property tax relief keeps recurring every year she owns the home. The retirement income credit applies every single year she withdraws from her IRA and collects her pension. Adjusting her IRA withholding down to match her actual bracket, instead of the inflated default, puts extra cash directly into her monthly distribution instead of loaning it to the government interest-free for 12 months. Stack all of that together, and you're looking at well over $2,000 a year in permanent ongoing savings, which, over a 15 or 20-year retirement, adds up to tens of thousands of dollars that simply stays in her account instead of cycling through a government office first. Here's what Margaret actually did when she understood all this, and it took her exactly 1 week. Monday, she called her preparer and asked specifically about the missing senior deduction and Form 2210. He filed the amendment. Tuesday, she called the county assessor and applied for the Homestead exemption, asking directly whether she could apply retroactively. Wednesday, she contacted the State Department of Taxation about the missing retirement income credit and requested the amendment paperwork for the last 2 years. Thursday, for anyone in her situation with a Medicare surcharge, that's the day to call Social Security with an SSA 44 and supporting documents. Friday, she called her IRA custodian and adjusted her withholding percentage to actually match her bracket instead of the generic default. 5 phone calls, about 3 hours total, spread across a week. Less time than she spends at the grocery store in a single month. And it recovered $4,800, plus locked in over $2,000 a year going forward for the rest of her retirement. And here's the part that should genuinely frustrate you. None of these 5 programs are new tricks, loopholes, or gray areas. The property tax relief programs have existed in most states since the 1990s. The underpayment penalty waiver for new retirees has been law since the late 90s. State retirement income exclusions have been on the books in some states for decades. The SSA 44 form has existed since Medicare's income-related surcharge itself was created. The only genuinely new item on this list is the senior deduction, and even that's been law for over a year now. These are not secrets. They're publicly available. Fully legal programs the government built specifically for people in exactly this situation. And the outreach simply doesn't exist to match it. Nobody hands you a checklist on your last day of work. There's no retirement welcome packet that says, here are the 5 things you're now entitled to. The benefit exists. The burden of finding it is entirely on you. And if you don't clear that burden, the government just keeps the difference indefinitely, with no penalty to itself for never telling you. So here's exactly what to do this week. Not eventually, not when you get around to it. First, pull your most recent federal return and check for that senior deduction if you're over 65 and under the income limits. If it's missing, call your preparer and ask specifically for a 1040X amendment. Second, call your county assessor, not the tax collector, and ask directly what senior property tax relief you qualify for and whether you can apply retroactively. Third, if you live in a state that offers a retirement income exclusion or credit, check your last state return for that line, and if it's blank or zero, request amended returns going back 2 to 3 years. Fourth, if you retired in the last couple of years and paid an underpayment penalty, ask your preparer specifically about Form 2210 and the retirement waiver. And fifth, check your most recent Medicare Part B statement. If you're paying more than the standard premium and you recently retired or cut back your hours, call Social Security and ask about Form SSA 44 with documentation of your retirement date in hand. 5 calls, 5 forms, less than half an hour each, and potentially thousands of dollars back in your pocket. Not next year, not someday, this month. Margaret isn't a special case. She's not wealthy and she's not unusual. She's a retired school teacher with a paid-off house and an ordinary fixed income, and there are millions of people just like her right now. Retired nurses, retired factory workers, retired office managers, who did everything the right way their entire working lives and are still overpaying today, simply because nobody ever explained the rules that were supposedly written to help them. That's the whole reason this information needs to be said out loud in plain language, because none of it is hidden. It's just never explained. And every month that goes by without making these calls is another month that money sits in someone else's office instead of yours. If you made it this far, tell me in the comments which of these 5 hit closest to home for you. The deduction, the property tax relief, the state income exclusion, the penalty waiver, or the Medicare surcharge. That tells me exactly which one to break down in full detail next.